So you are ready to take your trading seriously in 2026 and you're looking to prepare yourself now, ready to have an amazing year. Perhaps this trading year hasn't been as good as you'd hoped and you want to make progress, ready to have a good 2026. So how are you going to achieve your goals going into the new year, and how can you prepare yourself in the coming months to give you the best opportunity possible? In trading, people often say, how was your year? Or how was your 2024, your 2023? And I would say it is a good metric to actually track your progress. A lot of beginners, especially, will focus on the day's trading, the week's trading, or that month's trading, and base their whole profitability on how they performed in that short time period. But a good way to quickly improve is to lengthen the time you are assessing. So instead of assessing this week, how was I in the markets? Obviously, you still need to assess your performance, and your journaling should cover this. But when you are tracking your overall progress as a trader, you need to zoom out. You need to look at, okay, 6 months, how did I perform? Was that different from the 6 months before? Am I seeing improvements? You need to track all the progress. So not only do you want to track the performance of your strategy, so key signs here that a strategy is increasing in profitability, and obviously the way to do this is by collecting lots of data. One way to actually tell if this is happening is by looking at the drawdowns. If your average drawdown is increasing and your max drawdown is also increasing, this is a sign you are going backwards. There obviously can be difference in market conditions from one year to the next year, but with your strategy, you shouldn't really be seeing things that are out of the ordinary, things that you haven't seen in your data or that you don't expect to happen. Because if you're only expecting a max drawdown of 10 trades, let's say, and that's what you've only had historically, if you go into 2026 and you've just had a 20% drawdown in 2025, you might start to lose your confidence. And maybe you're thinking that you don't understand your strategy properly. And this is why you need to track your progress and not just trade a strategy assuming that it's profitable and it's going to be profitable forever. By tracking the progress, you can see certain aspects of your strategy that might be going downhill, that might not be working with the current market conditions. As we know, there's going to be volatile markets, there's going to be markets that just consolidate, and there's also going to be the trending markets. The trending markets, some strategies work really, really well. My strategy in particular works well when the markets are trending, and not so well when the markets are consolidating. So February, March, I was trading really, really well. We were trending a lot, but the middle part of the year, when there was a lot more consolidation, my strategy did consolidate a little bit. I wasn't consistently making 10% in a month. That just didn't happen. I'd maybe gain 2%, lose 1%, gain 3%, and it was kind of sideways. But that is what I'd expect, because I know from the data that that is what happens historically when I'm actually trading. And I'm not expecting something that isn't going to happen. And you only need to set targets to track your progress that are realistic. They need to be clear and realistic goals. If I know from the data and from my previous live trading experiences that my strategy has only ever made 20% in a year, for example, I can't then say in 2026 I want to make 50%, because what have I done to give me the confidence to actually make that 50%? What have I done strategy wise to improve my strategy by 2.5 times to make that profit? Obviously you can just increase your risk by 2.5 times, but this probably isn't the best way to do it, because then your drawdown will be a lot larger, which we do not want. We want to limit our drawdown. So how would I get to that 50%? You need to set a realistic goal. Perhaps you are improving something with your entries or your stop loss size, and you're cutting out certain setups and you're taking more higher conviction setups. This will give you the opportunity to improve your stats. Then you can potentially improve your risk, because you don't want to be the type of trader that sees other people making 50% and you want to make 50%, but you're only making 20%. So you increase your risk to try and match their profits. You don't want this. You want to compare your stats. If you're comfortable with a 10% drawdown in a year, let's say, and previously you've had 5% drawdowns, then perhaps you can increase your risk slightly. Because if you're comfortable losing 10% or having a drawdown of 10% and you're only having a drawdown of 5%, you can increase your risk. But you have to also expect that you do exceed that 5%. And let's say that is 5 trades. Perhaps you lose 6 or 7 trades in the next year. Again, you need to be prepared for this. Will you be comfortable doing that if you are using that increased risk? And speaking about risk, You have to only trade with what you can afford to lose. I see countless traders, they start a new year, they want to make more profit, so they start risking more of their capital. But they start risking money that they can't afford to lose. Let's say this second half of 2025, you've been trading really, really well, you've been making profit. That does not give you the right to trade with money you can't afford to lose. If you only have £1,000 set aside to trade with, money that if that is completely lost tomorrow, it doesn't matter to you, that is fine. You can trade with that money. I wouldn't say to put it all in one account. I would say you're better off using prop firms because it gives you access to much larger amounts of capital, and then 5% profit on a 100k account is obviously a lot larger than 5% on a $1,000 account, as we know using simple maths. So perhaps you allocate a percentage of that to prop firms. But let's say you're not really okay with only trading with $1,000. You want to make more money. So you use your savings account or your emergency fund or money you can't afford to lose into your trading account because you've had profitable months prior to the new year. This is a mistake that many traders make. And what you're going to want to do in this situation is just tell yourself, what am I doing? Is this a good idea? If I lose this money, if I have a massive losing streak now, the conditions change and I can no longer make profit, am I okay if all this money is gone tomorrow? That's the mindset you need to have with your trading. Your goal should obviously be to preserve your capital, but a lot of beginner traders don't have preserving your capital as their main goal. One of your top priorities in 2026 should be preserving your capital. The reason being, if you have 100k trading, you never want to lose that 100k. If you make 5% and you're now at 105k, this is good. You now have that buffer of $5,000 that you can use that buffer to make more profit. And every time you trade and you're in profit, you're technically risk-free. Obviously, those profits could be realized and they could be withdrawn, but then you are back at that stand of 100k. And then if you go above it, you then have that buffer again. But if you go below it, it can destroy many traders psychologically, which you do not want. But only risk what you can afford and still preserve that capital. It might be a low amount of money, but you need to preserve your capital. Having bad habits on smaller amounts of capital can lead to bad habits on large amounts of capital. And you do not want those bad habits to creep in when you start trading with prop firms or when you start trading with larger capital. That appetite for high risk or the appetite for not preserving your capital can be very dangerous. This is obviously very important with prop firms. If you can only lose 10% overall and that account is gone, then your number one goal should always be to preserve that capital and not lose that 10k. An easy way to do this is to decrease your risk and to not have any possibility that you do blow the account because you are looking to preserve your capital. So what you need to do coming up to 2026 now, you need to set yourself clear goals that are in line with your trading performance. You need to track all your progress, your rule following, your trade management, every aspect of your trading you need to track. And it's something easy to track. Just tick boxes at the end of each week, at the end of each month. And this can set you up with a good system to track your progress throughout the year. Perhaps there are some months where you don't perform as well and you need to identify why that is. And also only risk what you can afford to lose. Do not go in with large amounts of capital if it's going to change your life, if it's gone. That's a simple and easy way to destroy your trading career, which you do not want. So if you did enjoy, subscribe to the channel and I'll catch you guys in the next one.